One of the most significant obstacles to our own success might be our own inherent behavioral biases. In this video, we'll have a look at how to build investment strategies that account for investor biases. The concept of behavioral finance assists in our comprehension of our ingrained biases, which lead us to make illogical and even irrational decisions when it comes to investing and money. A prominent example of this is the prospect theory, which contends that people have distinct emotional responses to expected losses than to projected profits. According to the prospect hypothesis, an investor feels the agony of losses twice as much as they feel the pleasure of gains. Some investors are more concerned with their wealth's marginal percentage change than its overall amount. This flawed style of thinking might cause investors to obsess on the wrong issues. Now, let us look at some of the most typical behavioral biases that influence our financial decisions. But before we start our video, subscribe this channel and hit the bell icon for upcoming alerts. The psychology of investing biases. Depending on our individual investor personality types, behavioral biases have varying effects on us as investors. Cognitive biases include a tendency to act or think in a particular way or to follow a rule of thumb. The tendency to react based more on intuition than on facts is known as emotional bias. From a study by H. Kent Baker and Victor Ricciardi that looks at how biases affect investor behavior, here are 8 biases that may have an impact on investment decisions. Number 1. Anchoring or confirmation bias. We have a tendency to selectively filter information, giving greater attention to material that confirms our beliefs while disregarding the rest, which can make first impressions difficult to change. Similarly, if we come across something, or someone, new, we frequently fall back on pre-existing notions. When making an investing decision, a person who is prone to confirmation bias is more inclined to seek out evidence that confirms than disproves their initial assumptions. Number 2. Regret aversion bias. Remorse aversion, often referred to as loss aversion, is the desire to avoid experiencing regret after making a decision that has a poor result. Investors who anticipate regret take less risk since it lowers the likelihood of unfavorable results. In order to avoid having to face the truth that they have made terrible judgments, investors who are reluctant to sell lost assets may be suffering from regret aversion. Number 3. Disposition effect bias. This is an indication of a propensity to classify assets as winners or losers. In order to make up for prior losses, disposition effect bias may cause an investor to sell a winning investment too soon or hold on to a losing investment when there is no longer any potential benefit. This is detrimental since it may result in higher capital gains taxes and lower profits even before taxes. Hope you are enjoying watching this video. Make sure to subscribe to our channel and hit the bell icon. Number 4. Hindsight bias. Hindsight bias, which makes an investor feel that the beginning of a previous event was predictable and clear after the fact while, in reality, the event could not have been fairly expected, is another prevalent perception bias. Number 5. Familiarity bias. This happens when investors favor well-known or well-known investments despite the apparent benefits of diversity. When diversifying investments between well-known domestic assets and less well-known foreign securities, as well as between familiar and foreign stocks and bonds that are outside of his or her comfort zone, the investor may experience anxiety. This may result in less than ideal portfolios with a higher chance of losses. Number 6. Self-attribution bias. Investors that are subject to self-attribution bias sometimes blame external sources for unfavorable outcomes while attributing favorable outcomes to their own activities. This prejudice is frequently displayed by them as a kind of self-preservation or self-improvement. Self-attribution bias can lead to overconfidence among investors. Number 7. Trend chasing bias. In the false idea that previous returns accurately predict future investment success, investors frequently seek to replicate past performance. The fact that some product issuers may enhance promotion when historical performance is strong in an effort to draw in new investors complicates this trend. But research shows that investors do not gain since performance often does not last into the future. Number 8. Worry. Worrying is a normal and widespread human emotion. Worry changes a person's perspective on their own finances by bringing up memories and imagining possibilities that may happen in the future. Concern over an investment raises the perceived risk associated with it and reduces risk tolerance. Investors should choose an asset allocation strategy that is appropriate for their degree of risk tolerance in order to prevent this bias. Avoiding behavioral mistakes. A good financial planner would try to assist clients remove emotion from investing by identifying the frequent behavioral mistakes investors make and by developing a tactical, strategic investment strategy that is tailored to the person. Here are a few tactics that may be used to this end. Number 1. Systematic asset allocation. To establish a systematic plan of attack that benefits from market changes even during a down market time, we use investing methods like dollar cost averaging. Number 2. Risk mitigation. Knowing a person's risk tolerance is the first step in creating any investing strategy. Peace of mind is the most crucial component of behavioral finance. You may feel much more confident about your investment plan and be less likely to make typical behavioral errors by having a full grasp of your risk tolerance, the purpose of each investment in your portfolio, and the execution plan of your approach. Investors should avoid making investing decisions that are solely based on their behavioral biases by working with a financial planner to identify and understand their own personal behavioral biases and predispositions. This video has come to an end. I hope you guys found this video informative and helpful. Don't forget to like this video. Tell us in the comments below if you want to hear more from us and subscribe to our channel for more videos.